So PPI, big topic of discussion today after CPI. Are we believers at this point, or do we need more? What is the path to clear and convincing, Alli?
So we'll take it. We're not going to fade it, just like we're not going to fade the Fed. But I think it's a little too early for a pivot party, right? We have the beginning of some really exciting data. We have some comps that should be terribly beatable. But what we haven't dealt with is A, slowing growth, B, geopolitical tensions that continue to escalate despite, some of the things we see. And we haven't necessarily seen any of this work its way through the market from an interest rate perspective. One of the things that I saw that I've been focusing on is, and I'm going to have to read this, the Fed Senior Loan Office Opinion Survey that came out last week. Right, this is proven for many, many cycles to be a leading indicator, because what they're asking bank senior loan officers, are they tightening credit? Almost 40% are tightening industrial and commercial credit, and we have not seen any of that yet.
Does the price we pay for lower inflation is still to come, Urian?
I think the big win with the CPI, now the PPI, is that I think it's giving the market some conviction to look past peak Fed, if you will, whether that's at 5 or 5.25 or 4 3/4, and onto some return to a neutral rate, whether that's 3.5 or 4 or 3. And when you look at the math of valuations, market's trading at around 17 times now. The fair value kind of was around 15 based on where rates are. And I think what the market's doing is looking past the terminal rate and onto some normalcy. And to your point, I think the big question is, how far do we come down in terms of the inflation numbers, and do we go all the way down to the Fed's target? I mean, the Fed's kind of made it clear that it's willing to kind of throw the economy under the bus, I hate to put it that way, in order to get to 2% inflation. What if we go to 4 and kind of it stays there? What does that mean for the Fed funds rate relative to the natural rate? Do we stay kind of structurally restrictive? And what does that mean for valuation? So I think that's a 2023 story, but I think that's the next big chapter.
I want to go back to the data you just cited.
Yeah.
Does that suggest that if you're looking for earnings recession, if you're looking for economic recession, early indicators that it's going to be the industrial side of the economy that's going to take us there first?
It's a good question. So I think so we definitely at UBS are on the low side of earnings for 2023. We do see an earnings recession. We see a contraction of about 4%. We still see that the street needs to come down closer to us than the opposite. The question about whether there is a recession full stop, and what that looks like, I think is still to be determined. But I think that the way you get around that, and the way you can get around sort of any volatility, is to invest into demographic trends, right? So we are pushing people into oil. We're pushing people into the parts of real estate where demographics give you a tailwind, and healthcare, where we see a global need. We see technologies, many of them that were developed during the pandemic, that can help catalyze. But look, I think that we are in a terribly precarious situation. I think we have more to be positive about now than we did 3 months ago. So whether you're calling it peak inflation, peak uncertainty, peak angst, I think that there is a definite path forward. But I don't think, again, I think it's too early to call a pivot party. And I think it's too early to say that this is a sustainable rally to the upside.
Okay. Urian, I want to get your thoughts on this and how you'd be positioning, or you'd be counseling folks to position, investors to position, given this conversation we're having. Yeah,
I mean, it's certainly the question about earnings is a big one. If you look at X-energy, which is only a small sector but producing 100% earnings growth, the estimated growth rate for this year, which of course is almost over, is only 1.2%. Inflation's 8%. So in real terms, earnings growth is already negative, and it's probably going to stay that way. The hard part is that it's a very nonlinear exercise, right? Usually price bottoms 2 quarters ahead of earnings. So even if we get the right E in that PE, it still doesn't necessarily tell us whether the market has bottomed or not. And so I think you can make the case that we've seen the worst levels. Market fell 28%. Average bear market is 33%. But it's hard for me to see the bullish catalyst here. We're trading already at a 17 multiple. Even if rates back down further, it's hard to justify more than that when we're still kind of looking into the eyes of possibly a recession in 2023.